The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The risk-on rally, well, it morphs into a risk-on rotation. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's take a look at this rotation. Certainly a rotation out of tech stocks. The NASDAQ 100 down by about 0.2%. The S&P 500 pretty much unchanged. It was higher earlier in the session, but giving up some of those gains. Rotating into bonds, you can see the 10-year Treasury yield lower by about 5 basis points right now. We're still above 4%, but we'll see if this gains more steam. And I also wanted to highlight Bitcoin here. Sort of wraps into the risk profile of this market. Bitcoin down about 1.3% at the moment, Romaine.
Yeah, we talk about that rotation, the rotation that we saw yesterday out of technology and into some of the lagging pockets of the market, like healthcare, that continuing here on a second day. Lilly, AbbVie, Elevance among the notable gainers, while high valuation tech stocks like your Metas, your Nvidias, your Palantirs, seeing some profit taking from the recent record runs. And that might actually be a reflection of what's going on in Washington, the potential for the end of the government shutdown, and of course the government economic data pipeline turning back on. Across the last 20 shutdowns going back to 1976, the S&P has averaged gains of 1.2 and 2.9% in the 1 and 3 month periods following a budget resolution, with pointed gains particularly in the stocks of companies that sell consumer goods and services. So keep an eye on those. Now, that doesn't mean that the tech trade itself is tamped down altogether. You take a look at AMD, the nearest rival to NVIDIA in the AI chips race, jumping as much as 11% after predicting a path to more than $100 billion in data center revenue by 2030. That forecast coming as Anthropic, for the first time ever, said it would take on directly its first major data center build-out, a $50 billion project that suggests, Katie Greifeld, the AI spend is far from petering out.
Well, speaking of AI spend, let's put that into context. It's all we've been talking about this past earnings season. You have behind me a chart of estimated net CapEx. That is, of course, CapEx spend versus depreciation. We're looking specifically for S&P 500 firms, estimated to hit $100 billion for the first time ever in the third quarter. And I thought this waterfall was really interesting because you can see how this spend has been building and building. We had, of course, been nearing levels that we reached maybe a decade ago, but certainly in the past few quarters, Romaine, you can see we've burst right through that. So really, we're looking at records here when it comes to spend. We already knew that, but taking a look at it in context certainly speaks to the anxiety in the market right now that maybe we're not going to see the return on investment that would justify some of these levels.
All right, well, let's get some more context as we kick you off to the close here on this Wednesday afternoon. Luke Barr, Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management, joins us here in Studio 2. Luke, great to see you.
Great to be here.
We talk about an AI trade. We've heard all the statistics about just how narrow this rally has been. It's been driven almost entirely by AI, and to a larger extent, that AI CapEx spend. Does that continue?
We think it does. Katie just referenced the data point through third quarter. What we've seen through earnings in the last couple of weeks is evidence that, yes, there's been a lot of money being put into AI holistically, but the signs of that slowing down still slightly limited. I think we're going to see $360, $400 billion this year of AI CapEx, and we probably see $1 trillion over the next 3 years as companies continue to invest in that space. And it's really about how do I build the models, how do I stay up with the pack, and then where is the opportunity that comes from that? Because it's not just what we've seen in the last few years, it is going to evolve, and I think that's the key investment consideration.
So no signs of this slowing down. I wonder, though, for investors who are watching this just continue, and you think about some of the projections in terms of where AI is going to go. I mean, when do we start to see sort of push comes to shove and investors maybe get a little bit impatient about when we're really going to see this translate into meaningful productivity gains or something else for these big companies?
I think to a degree, Katie, you are starting to see that. You've seen the reaction to certain guidance in earnings. You've seen the reaction in the market more recently, where if companies aren't necessarily being able to articulate how the ROI is going to come in the near term, then they are getting penalized for that. But I think we have to take a step back and say, okay, what about the medium-term opportunity here? Because the AI story is transformational, and the opportunities that come from that are transformational if you can identify who are going to be the winners and losers. And so if we start from this clear, critical consideration of the big get bigger, and those that have dominant data and application flexibility and capability are going to need to spend to stay ahead of the pack, that could still be a very compelling medium-term story.
I know AI has sort of sucked a lot of the air out of the room, but we're seeing a lot of other sort of big transformational moments in other industries, including in the healthcare space. And I was pointing out at the top of the show, at least over the last couple of sessions, we started to see somewhat of a rotation into healthcare. I know some of that is just kind of, going after the laggards and hoping that you can take that ride. But when we talk about weight loss drugs, or you even talk about the injection of AI and other technologies into the drug discovery process, are you seeing opportunity there as an investable asset class right now?
We see huge opportunity. And I think in healthcare especially, that is where you start to see innovation really on sale. You're getting an opportunity to enter into some very critical transformational themes at a multiple that looks very different to other parts of the broader innovation ecosystem. And so what I would say in healthcare is twofold. One, you've seen a real shift in the last 5 years or so around large cap pharma R&D spend. You'd been on this structural decline in terms of R&D spend, outsourcing that to some of your biotech businesses, and that's actually started to change. And what you're starting to see is the evidence of that leading to transformational solutions in the healthcare space, not just the GLP-1 trade, but things we're seeing in Alzheimer's, things we're seeing in diabetes, more holistically, that not only have life impact, but actually can be very accretive to earnings and growth. And I think more broadly, one of the challenges in healthcare in the last few years, at least post-COVID, was in a funding environment that's more challenging as rates have moved higher, that biotech part of the ecosystem that's been very focal for generating innovation has been a bit challenged because people have said, okay, how do you fund that growth cycle? Now we're seeing a little bit more comfort the innovation is coming through. We're seeing some of the animal spirits come back. And so the M&A cycle for large cap pharma that's built up cash on balance sheet, going and effectively acquiring some of that innovation in the biotech space really is quite compelling.
Well, it's fascinating. I mean, we're just coming off the heels of a bidding war for Metsera, for example. Looks like Pfizer finally won out there. Look, we don't have a lot of time left, but I want to talk about small caps because I'm taking a look at your notes. You identified that U.S. small caps potentially being attractive here. I've heard so many bull cases for small caps. They never seem to stick around here. What's going to be different this time? Well,
I think full disclosure, we've been bullish on small caps in the last 18 months and haven't necessarily been on the right side of that. And so we've got to recognize that part of the trigger for that and the catalyst was a better economic backdrop with rates coming down, and that is very helpful for the small cap asset class, which is floating rate debt, short maturity debt. So there's a positive impact on the bottom line and the margin that comes from Fed policy starting to become a little bit more favorable. But I think more holistically, if we look at what's happened in the last couple of quarters, and I say this from an active management perspective, you've seen very strong performance out of a subset of the small cap space, which is typically your least profitable, most volatile, arguably lower quality part of that ecosystem, and you haven't seen the pickup and the rally in the higher quality ecosystem. So as we think about healthcare as a great case in point, that biotech space looks compelling. If we think about AI and technology, the broadening out of that theme into the smaller cap utilizers of that technology and the application software businesses within that space, you're getting that at a very different multiple, which with a robust economic backdrop, which is still our base case, can be a very compelling forward story.
All right, great insights there, Luke. We got to get you back for a longer conversation. Luke Barrs there is the Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management, kicking us off to the close on a bifurcated market here for a second straight day. When we come back, we're going to talk about the best performing stock among the 1,000 biggest stocks out there. It's On Holdings, spreading past expectations. We had a chance to catch up with the CEO. That conversation coming up next. This is The Close on Bloomberg.
Shares of On Holding running higher after the Swiss athletic apparel brand raised its sales forecast for the year and delivered better than expected third quarter results. We had the chance to catch up with Martin Hoffmann, On Holding CEO and CFO, about the regions where he's seeing the most growth and the strategy to keep the momentum going. Let's take a listen.
Our strategy is to build the most premium global sportswear brand. And so what premiumness means is a feeling that a customer has towards a brand. So we are curating this feeling by investing in the product, in innovation, in quality, in design, by investing in the experience that you have when you come to our store, when you engage with us at community events, when you see how we are talking and working with our athletes, with our cultural influencers. And that really sets ourselves apart, and we are chartering our own way here. Instead of fishing all in the same pond, we are bringing new customers into the sportswear segment that have not been wearing sneakers before, that didn't wear sportswear-inspired apparel. And so this is driving the growth, and this is driving the global momentum. Because we are so focused on that, this gives us full confidence for the rest of the year and for next year.
You've positioned yourself as a premium product, and I was listening to the conference call. I lost track of how many times you used the word premium. You've passed on pricing with regards to tariffs to customers earlier this year, and you also made comments on the conference call that you feel you are in control right now of pricing. If economic conditions do soften, does that work against you?
We're very much convinced that if you have desire in your product, then you can sustain a lot even in more choppy waters. And our focus is on the innovation of the product. And we have an amazing product pipeline also heading into next year with our Cloud Runner relaunching, our Cloud Monster coming new. And then we have Light Spray, which is really a revolution to the whole running industry, not only how the shoe is manufactured, but much more the lightness and the performance of the product. So there is a lot of desire that we are building for the brand that expands also from footwear into apparel. And with that, I think we are in a good position. And then we are a global brand. And you see the momentum that we are having in the Asia-Pacific region, where we have now really doubled our sales.
Do you have any more price increases planned in the future? How many more times can you pull that lever, so to speak?
I think this is where we are in a great position. You see that in Q3, we had a record gross profit margin of 65.7%. So what we have done is we have gained so many operational efficiencies in our business, and our premium business model puts us in such a strong position that we are gaining more gross profit than we are losing towards tariffs. So we are in a position where we are in full control. We don't need to increase prices to offset that. We don't need to work with our factories on lower costs to offset that. We can really invest in what is driving the brand in the long term. And so for the moment, we don't have planned for price increases going into next year. But we are a premium brand, and so we are very much observing the market, and we are in a position that we can react.
Well, we'll keep an eye on that aspect. I do want to go global here, because you think about one of the reasons why you're seeing such a strong reaction in shares right now. It could be what we're seeing on the international landscape, particularly when it comes to the Asia-Pacific region. Revenue growth there jumped 109%. It's now almost 20% of sales. What is going right in Asia-Pacific, and what products are resonating there versus a more mature market such as the United States for On?
I think if you go to shopping malls in Shanghai, in Singapore, in Bangkok, you experience a very premium shopping environment. And this is perfect for On. And we are really elevating the experience there. And the Asian customer is really looking for sports-inspired premium products. And On is in that center. And so we are seeing incredible demand from China to South Korea to Southeast Asia, as well as in Japan, where we just had the World Championships. And this is a story that we see in Asia, but that continues basically into all other regions, but of course at different maturity levels.
I am curious, Martin, about the diversification of your product offerings. That's a really nice sweater that you're wearing there, but I don't see them a lot anywhere. And I am curious as to when we start to see a more material push into apparel, and when apparel starts to make up a bigger percentage of your total sales.
Yeah, which is very much a part of our strategy. I mean, today, apparel is about 8% of our sales, so it's a very small part. It comes to life in our retail stores, where it already takes about 15 to 20% of sales. So it's definitely a category where we have a lot of belief in for the future. It's an additive category, so it really brings new customers into the brand. We see a lot of first-time buyers in the apparel category, but it's rooted in the same belief of really elevating the experience that you have with sportswear-inspired apparel, investing into materials, investing into designs. And you have seen we have doubled our apparel sales in the third quarter, and we are well on track on gaining share.
And that is Martin Hoffmann, the CEO over at On Holding, a company, of course, that wasn't even around 15, 20 years ago and has now grown into a behemoth. It's also worth mentioning that the company, which is backed by Roger Federer, rose as much as 26% in the intraday. That's the highest intraday level since 2023. We want to bring into the conversation Janine Stichter, BTIG's consumer retail and lifestyle brands analyst. She's had a buy rating on the stock for the past 12 months. All right, I mean, not only were the results from the past quarter not only pretty decent, but they're telegraphing something like 34% revenue growth going forward on a constant currency basis. I assume you're pretty pleased with that.
Yeah, I think this result really cleared the air. There have been some concerns about potentially slowing growth. They just did 35% growth in the quarter. They guided to 34% for the year. And they're also telling us a view into 2026 where they think they can do at least 23% growth, which is a really good number as a starting point for the year.
And it's interesting, something that we talked about with Martin is sort of the divide between apparel, what they're planning to do there, the growth opportunity, and then the athletic performance core. And I wonder, how you see them towing that line going forward.
I think at the end of the day, they are committed to performance. If we look at what they've done on the running footwear side, where they really built credibility was with marathon runners, with trail runners, with the top athletes in their sport. And I think they'll do the same thing in apparel. When we think of their apparel strategy, I don't think they want to be in the fray of this athleisure world where there's a ton of competitors. They want to be at the top of the market, be at the pinnacle of the market where it's really about performance, and that's where you can charge a premium that they're going with the pricing strategy.
But that performance space is now starting to get a little bit more competitive as well. You have upstarts like Hoka, which of course have tried to make their mark, Norah and a few others, and then you have big companies like Nike that are trying to get their mojo back in that performance space. Does that become a threat to On?
I think two things here. First, on the performance side, there's a tremendous amount of loyalty in the running category. Once consumers find a shoe that really fits them and works for them, they tend to stick with it. So we see a high level of repeat purchases. The other thing that I think differentiates On from a company like Hoka, where we think they're more reliant on performance and on run specialty, is the lifestyle side of the business. They have a piece that's probably a third or so of the business. It's hard to quantify because there is some overlap, but that is kind of everyday casual wear. We see people wearing it in offices, we see people wearing it on the streets, and I think that part it gives them a buffer against any potential slowdown or more competition in the running market.
I also want to talk about the different markets globally that they operate in, because, of course, you take a look at Asia Pacific, obviously great results there in the quarter that was, Europe as well. But when it comes to the U.S., that is their main market, of course, do you think that they could be approaching a saturation point?
There's really no signs of that. I think at any point you're going to see some level of normalization of growth. But we saw that the Americas still grew over 20% in the quarter. They talked about it growing even stronger in Q4, so it sounds like holidays off to a strong start. And that's amid an environment that we know has been very challenging. We've had a lot of inflation. We've had more of that coming with tariffs, and they just haven't really seen the impact to their business.
Well, this gets to this idea, too. I mean, they've obviously passed on some of those costs, and we asked them a lot about this idea of being a premium brand. But when you talk about pricing and holding that line on pricing when times really does get tough, do you think they will do that?
I think they will. What we've seen over the course of really the last 2 or 3 years, where the environment has been all different sorts of choppy, is that consumers are really being very opinionated in what they want to spend their money on. And they're spending on those things and they're pulling back in other areas. So we're seeing right now, for example, casual dining, companies like Chipotle, they're seeing weaker trends because consumers are saying, no, we're not going to tolerate the price increases we've seen, and we just don't think the value proposition is there. Versus for a category like footwear, where it's something you wear every single day, there's a high level of utility, the brand really matters, the comfort really matters. Consumers are willing to pay that extra $10 for something that they view as a strong value proposition.
All right, Janine, great to get some time with you, especially on a day when On shares are soaring, rather. Boy.
Wow.
It's
intentional?
only Wednesday,
Were you trying to do an
too.
intentional pun?
No, I was trying to say two words at once. In any case, Janine, great to spend time with you. That is Janine Stichter. She is BTIG, Consumer Retail and Lifestyle Brands Analyst.
Now, do you have a pair of these? I know you're a big runner.
I'm a Hoka fan.
You're a Hoka fan.
Yeah. But boy, is it fun to cover On Holding, because
I'm a Gucci fan.
You're a Gucci fan?
Yeah.
Okay, they
can't really run in them, but
more lifestyle, I would imagine, than the athletic core that Gucci is targeting there. We'll continue to follow, of course, the sneaker wars. But coming up, auto loans losing their status as one of the safest consumer credit vehicles out there. Could it be a canary in the coal mine, hinting at a broader credit crunch? We'll unpack the mounting pressures next. This is The Close on Bloomberg.
What TikTok are you on?
U.S. auto delinquencies are up 50% over the last 15 years, pressuring a corner of the credit market previously seen as one of the safest for consumers. Is the strain indicative of broader risk or simply an adjustment to climbing car prices and higher interest rates? Let's ask Stuart Paul, U.S. and Canada economist over at Bloomberg Economics. And I'll start right there, Stuart. What do you make of some of those stats and what it says about the broader economy right now?
Well, so the big indicator that we saw this morning was that there was basically an all-time high level of delinquencies, particularly in subprime autos. And look, the lower end of the income distribution is always going to fare worse than the rest of the income distribution. Autos are also somewhat unique in that prices had run up dramatically when there was a lot of exuberance post-COVID, when it was difficult to get your hands on cars. Now we're at the point where the business cycle is normalizing. We're not running nearly as hot. Fourth quarter growth is going to run at an annualized pace of just about 1%. And so folks at the lower end of the income distribution are suffering, and they're realizing the replacement costs for vehicle parts, insurance costs are all through the roof. And so when they're feeling strained by an already high loan payment on their car, it's just easier to become delinquent and walk away from the vehicle, let it get repoed, than it is to continue stressing over those payments.
But I wonder, though, does this sort of broaden out, too? I mean, as far as the car stuff, I remember all those viral videos of people bragging about how big their car payments were, and I was like, why is that something to brag about? But it gets to this idea that if there's cracks there with regards to auto loans, and we've seen other delinquency data for just, revolving credit and other forms of debt are also elevated as well, at some point, do you not start to worry, as an economist, do you not start to worry about what the ramifications are?
It's the sort of thing that at least makes my ears perk up. And then I look at the broader swath of data. So when we look at charge-offs by credit card companies, they're now declining. You look at the flow of household bankruptcies. The monthly flow is just about 20% below where it was pre-COVID. You look at things on the upper end of the income distribution. You have mortgage rates coming down. That'll support home prices. You look at things in corporate America, and spreads are still narrow. So I do think that there is something that's relatively unique about autos in this moment, this post-COVID trajectory that we've seen that's made autos somewhat unique here.
And we only have about 30 seconds left with you, Stuart, but how do you think that the Fed is reading some of these different data releases, especially when you mentioned that autos may be in their own category here?
I think that the Fed is, I think that you have two camps in the Fed. The first is the more academic camp that sees rates as still relatively restrictive relative to some abstract, neutral R-star rate of interest. And then you have folks who just look at asset prices, they look at narrow credit spreads, they look at financial conditions, and they're going to be hard-pressed to say that monetary policy is restrictive right now. So it's no wonder Powell was signaling that it's not a done deal in December.
All right, Stuart, got to leave it there. Stuart Paul, U.S. and Canada economist for Bloomberg Economics, as we continue to march closer to those closing bells here on this Wednesday afternoon, a record day for the Dow, but not necessarily for anyone else. We're going to talk markets, and we're going to talk about it with Raymond James. They've been making some major investments in the tech space. The CEO, Paul Shoukry, joins us next. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. About 30 minutes until those bells ring, and you
Can I just tell you, I actually love the new J.P. Morgan building.
You
have to look at it late at night, though, too.
Yes.
Yeah, like whoever did, I don't know much about the architect, but whoever did that, kudos.
Or you have to look at it early in the morning. I run on the waterfront on the Jersey side, and I can spot the J.P. Morgan building. But yeah, maybe we've talked about it enough, though. Should we talk about markets?
Sure, let's do that.
Okay, I want to do something I never do.
What's that?
Highlight the Dow Jones.
Wow.
It is at an all-time high right now, Romaine,
which
usually I don't point at it because it's price weighted. What does that mean? But rising for a fourth day in a row. And then you think about the S&P 500 not doing too much, a rare day of Dow outperformance. And it's an interesting day overall because we could finally be nearing the end of that government shutdown.
Yeah, and that seems to be a bit of the catalyst for the rotation that we've seen. I'm not sure what it's going to amount to because they're saying it's still going to take some time for things to get back to normal. And let's point out, we are awaiting a House vote at some point after the bells tonight, but that's not a done deal. Mike Johnson says they have the votes, but we're now hearing some reporting from Bloomberg based on sources familiar with the situation that he might be a couple of votes short.
Well, the countdown's certainly on. As we wait, let's talk more about what we're hearing when it comes to investor sentiment with Paul Shoukry. He is Raymond James CEO joining us on set. Great to see you, Paul.
Oh, great to be here.
So let's start there. You, of course, have a very unique view on the lay of the land when it comes to sentiment. And when you take a look at advisors, what their clients are doing and saying, how does sentiment look right now?
Yeah, the advisor and client sentiment is very high right now. I was just at a dinner last night in downtown New York with 250 advisors, and the morale from the advisor community is through the roof. They're managing, on average, record levels of client assets and production. And most importantly, the client sentiment is very high. The equity markets are near all-time highs, and so I know there's a lot of headlines around tariffs, government shutdown, and those type of things, but I'm not hearing a lot of those concerns when I'm out on the road, and I spend 80% of my time out on the road and meeting with advisors and clients. I don't hear too many concerns around those type of headlines.
Yeah, it's pretty wild to look at the S&P 500 higher by about 16.5% year to date. I want to talk specifically about Raymond James, because one of the big reasons why you've seen such a resilient market is this belief in AI really powering some of those huge technology companies. I know when it comes to Raymond James, you recently filled your chief AI officer role. You also hired a head of AI strategy. What does AI look like for Raymond James and basically the business of wealth management?
I mean, the leadership team at Raymond James, we have a conviction that AI is going to be an absolute game changer, not only in our industry, but in all industries. And so we made these key hires to really build out our AI strategy across the organization. I'd say it's a three-pronged strategy. It's first starting on efficiencies in the back and middle office to do more with the same number of people. It's also to protect the firm, the foundation, the cybersecurity, where so many of the false positives were historically monitored and evaluated by humans. Now those can be done in seconds through AI and automation. And then, of course, helping advisors and financial professionals with client-driven insights to help them develop more personal relationships with the help of technology. And so we're looking at AI not from a lens of circumventing or going around our financial professionals to go directly to clients, but really from a lens of how can we enable our financial professionals, our financial advisors, to develop even more personalized relationships and tailored relationships with their clients.
As you sort of build out those AI and technology capabilities, is that going to be done sort of organically internally, or are you looking maybe to potentially make acquisitions to help?
Well, it's really all of the above in terms of building AI technologies organically and internally, but also partnering with third-party vendors. Because every third-party vendor that we use, including Bloomberg, they're integrating AI into their solutions. And so the team is really looking at where does it make the most sense for us to leverage the AI that's available to us. Do we want to build it in-house? Does it make sense to build it in-house? Can we do something differentiated with it? Or should we partner with a third-party firm that's doing that on their specific area of expertise?
I am curious, though, about just the general impact right now of economic conditions, and more, I guess more importantly, interest rates as well. And I know on your earnings a few weeks ago, you talked on the conference call about this idea of actually how a drop in interest rates to a certain extent might actually help your business, at least on the lending business side of that business. But I am curious if you could kind of articulate what a lower interest rate environment is going to mean for Raymond James and your clients.
Yeah, we're in a diversified financial services firm, so there's always puts and takes with anything that happens in the markets or with interest rates. Lower rates, we believe, will be helpful to the M&A business. We have a large investment banking and M&A business. Lower rates, especially if financing is still available to the extent that it is today, makes valuations and makes financing transactions more attractive. So we think that could be a nice tailwind for the M&A business. You talked about loans to our high net worth clients, mortgages and securities-based loans. Those are floating rate loans. So lower rates should increase borrowings there, as it did when rates were near zero during the pandemic. But then in terms of some of the offsets, certainly the spread, the earnings we have and the spreads that we make on cash balances will go down. So that would be a potential offset to some of the tailwinds.
I also do want to bring private markets into the conversation, specifically in the context of wealth management, because we know that private assets, all the rage right now. And I wonder, what it means for Raymond James. You think about the competitive landscape here. You had Morgan Stanley buy EquityZen. Schwab just bought Forge Global, I believe. So what does your offering currently look like, and how do you see it evolving over the next couple of years?
Yeah, we've been investing in that platform for a long time. I mean, the underlying premise is that more companies are staying private longer, and these are high growth companies in a lot of cases. And so we want to be able to enable our advisors to provide access to their clients to invest in those type of companies. At the same time, what private markets means has expanded dramatically just in the last 3 to 5 years. And so we want to make sure, first and foremost, that any investment that advisors sell to their clients makes sense for their clients and their positions. These are relatively illiquid to public securities. And so we need to make sure that clients are comfortable holding that amount of liquidity in their portfolio, because it tends to become less liquid when you need the cash the most. And so we're having a balanced approach, just like we do with everything. It's really, it has to make sure, we have to make sure that's consistent and aligned with the long-term financial plan of the clients.
You said you travel a lot, as you would expect a CEO like you to do. I am curious, though, how much time are you spending in Washington right now?
I'm actually going to Washington next week, so I didn't get invited to the dinner tonight that I guess a bunch of Wall Street CEOs. I still can make it if I get the invite here in the next 30 minutes. And Paul Riley, who was my predecessor's executive chair, he's spending a lot of time on Washington too. He's on the board of a industry association. So we are engaged in Washington, but I really try to spend most of my time with advisors, financial professionals, and clients. And so that's where I'm spending the bulk of my time when I travel.
Yeah, it's a much nicer bunch than the folks in Congress. Paul, great to have you here. Paul Shoukry is the CEO of Raymond James. When we come back, we're going to talk about AI and a big bet on that future, sending AMD shares soaring. Some commentary out of Lisa Su, that conversation coming up after the break. This is The Close on Bloomberg. All right, one of the big movers on the day is AMD. It is our stock of the hour. At one point, it was up more than 10%. This after some commentary by CEO Lisa Su saying the chip maker will see accelerated sales growth over the next 5 years. Strong demand for those data center projects. Bloomberg's markets correspondent Norah Mulinda joins us right now for our stock of the hour. And once again, Norah, there's always these doubts here about how much further this AI spend goes. And we got a couple of big points on that today from Anthropic and, of course, from Lisa Su and AMD.
Absolutely. We are seeing a lot of people pouring a lot of money into pushing AI forward. But of course, the concern still remains whether or not we are seeing a lot of these companies hitting a lot of lofty levels. I mean, if you look at AMD, this stock has been on a tear. I mean, for shareholders, this was a laggard if you think about it against the likes of NVIDIA or Intel, its peers here. But you definitely are seeing this stock doubling in this year alone. So it has really been on a wicked rally in comparison to the counterparts that I just mentioned. NVIDIA not up as much year to date.
Yeah, it's fascinating. You compare the year-to-date charts.
Wait, it's outperforming NVIDIA?
It is outperforming NVIDIA, which is wild. I had to double check that.
Wow, you're right.
AMD up 112% on a total return basis. NVIDIA only higher by about 43%.
That's
Just pedestrian moves here for NVIDIA. So share performance aside, I mean, talk to us about the fundamentals here. One of the reasons NVIDIA has been such a heavyweight, why it has trillions of dollars in market cap, is because it really had this first mover advantage. It was able to build a moat. How close is AMD when it comes to actually catching up here on a fundamental level?
So that's what everyone has their eyes on, because as you mentioned, we really did see NVIDIA coming out here out the gate, securing all of the big names as clients here. If you think about AWS or you think about all the other cloud developers, they're all working with NVIDIA. So while AMD is doing well and we are seeing results that echo and underscore that, the question is, are they able to keep up with the pace? Are they able to really maintain this momentum, especially if you think about the fact that people are pretty critical of anything that is not a major beat. So if is there any sort of supply chain constraints or anything that essentially threatens the potential for this stock to really run, you really are going to see Wall Street coming down with a hammer and really giving them some sort of punishment here.
And this is always a reminder that I think next week, a week from today, I believe, we get NVIDIA's earnings, which is, I kind of feel like at this point they should be reporting at the start of the earnings season just so we can kind of get it out the way. But it gets to this idea, and I kind of want to bring in the Anthropic deal as well. They're basically saying they're going to spend $50 billion to actually build out their own data center rather than relying on others. And it gets to this idea of not just the amount of CapEx spend, but the idea that no one really seems to feel like it will slow down. We had someone on earlier from Goldman Sachs Asset Management saying the same thing, that whatever, 3, 4, 500 billion we're getting this year, it's going to be higher in 2026 and probably even higher than that in 2027.
I mean, you are hearing people so bullish right now in this season when we think about AI and just the build out there. But as I was mentioning before, the concern for some of the analysts that I was talking about is, hey, if we keep having these lofty expectations and we expect beat after beat after beat, if one of these companies, if we use AMD in this situation in particular, doesn't meet that mark, I mean, you're definitely going to see intense scrutiny, especially as we think about all the money that's being spent right now. We want to see return on investment. That's what investors
This is like the point Katie always makes, too, about the circulating to the Aurora Borealis.
We need the chart, right?
Ouroboros.
Ouroboros.
The snake that eats itself. And you have to wonder how it ends. Does the snake
Did you know
choke,
Lisa Su and Jensen Wong are related?
I feel like I just put that in
They're
our
like
show
cousins,
chat.
right, or something? Yeah.
I think they're
more
first cousins.
Yeah.
I feel like that's such a fun bit.
Some more
add that to the chart.
But I don't know. We'll see how it all ends.
Do they get together at Thanksgiving
That's
and just talk about just how great it is to
There's
be?
definitely been reporting on this, how much time they actually spent together.
I would kill to be at that Thanksgiving table.
Yeah, really?
Yeah,
fly on the wall.
Well, it's coming up. Maybe you'll get an invite. Maybe someone important is watching.
I'd probably get invited to the White House before I got invited there. So.
Norah, Mulinda, great reporting, of course, on
love me
AMD.
at the White House, by the way.
Big pop in the shares, and of course, we have more earnings after the bell in terms of taking the pulse of this AI trade. Cisco coming up later, but coming up next, we're going to take you to the closing bell with Dina Ting of Franklin Templeton. That conversation up next. This is The Close.
The AI story is transformational, and the opportunities that come from that are transformational if you can identify who are going to be the winners and losers. And so if we start from this clear, critical consideration of the big get bigger, and those that have dominant data and application flexibility and capability are going to need to spend to stay ahead of the pack, that could still be a very compelling medium-term story.
Luke Barrs, Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management, kicked us off to the close, Katie, just about 50 minutes ago. And he still seems pretty optimistic here about this AI trade and the fundamentals underpinning it.
And small caps as well, which I thought was charming. He did say that they've been on the wrong side of it many times in the last 18 months, but maybe it'll start working. Let's take a look at where we stand.
Is it working today, Katie Greifel?
I don't not a lot is working today, other than the Dow Jones for whatever reason. You do have big moves when it comes to United Health, Goldman, Cisco, et cetera. That is pumping up your price-weighted index. The Russell 2000 is lower on the day. The S&P 500 managing to poke into the green. We'll see if it can hold its gains. Bitcoin a bit lower, and some money going into bonds as well, which is interesting, Romaine.
Absolutely. The bond market reopening today following the Veterans Day holiday here in the U.S. The Dow outperforming the S&P by some of its widest margins that we've seen in quite some time. You add it all up, and there are a lot of opportunities to invest here in the U.S., but also maybe a lot of opportunities to invest overseas. Dina Ting joins us right now, head of Global Index Portfolio Management at Franklin Templeton. Dina, this morning I was reading a note from the folks over at Citi, their global equity strategy team, basically recommending emerging markets and European stocks. Peter Oppenheimer also talking about this idea that U.S. equities will lag global equities over the next few years. And even Sachs Market says if you're interested in AI, you should be actually looking to Asia and not necessarily the U.S. You see a lot of opportunities outside the U.S. as well. What's best?
For sure. So on a day or a year like this year where you see a huge dispersion of return, if you look at the top performing like South Korea is delivering 80% year to date, there is certainly opportunity to invest in areas that you mentioned. One is their economy is driven differently, and now there's this tariff that is bilateral. So the impact on each country and how they will perform really matters, and that dispersion of return is really bringing the importance of, one, looking at where valuation is still attractive. Second is also looking at the diversification and the correlation. What is noticeable this year, the correlation of international market versus U.S. is actually lower than it has been compared to the 3-year average or the 5-year average.
Why do you think that is?
Part of that is because people are starting to see that they are not moving all the same way. That's what's driving each of the country is quite different. And the other part of it is because of the bilateral agreement, right? So what impact one country could be completely different within the other country. Take an example of China, for example. At the very beginning of the Liberation Day, you see like the worst case scenario could potentially happen. Now we're at the period where both sides seems to come to understanding that, hey, you know what? We have to work together to move forward. And now the doomsday scenario that people were expecting is not there. So I think there's like that calming period. But the volatility that we see on that date was a huge spike. Now we're 6 months into it to see where potentially people can invest. And there's definitely changes, right? The valuation in the U.S. has been overstretched, and that's typical on a market that is popular.
Right. So I hear what you're saying, especially when it comes to valuation. I think, you know, one of the defining stories of 2025 markets will be this rest of the world outperformance. But even still, you think about the average U.S. investor has such a strong home bias. So what does that pitch sound like, trying to get U.S. investors in particular to maybe look overseas and consider a market that isn't just the United States?
Yeah, the pitch is there is always potential to outperform, right? I think you look at the hard facts, look at the numbers at the end of the day. I know it's like difficult because people tend to cling to what they know has worked in the past. But if you have a broader lens, if you go back 20 years, international market has outperformed the domestic market for some time. And this year, I think the number will speak for itself. And if it's not just for pure performances, it's also for diversification, right? You don't want to put all your eggs in one basket. So it's always, and the fact that the valuation is so attractive is another pitch, so to speak.
Right. But you wrap AI in, and you think about the American tech industry. It's one of the reasons why you have such strong outperformance from the NASDAQ 100 and even the S&P 500. It is such a huge weight. And then you think about Europe. It doesn't really have the tech industry in the same way that the U.S. has, and I'm sure that applies to many of these other regions as well. So do you ever get that pushback that folks are worried about missing out on the AI trade if they do diversify outside of the United States?
If they do, you can say that Asia actually is where the power of the AI comes from. Just look at Taiwan, look at Japan, look at South Korea. They're the one who power the semiconductor piece of it. So the AI will not happen unless you have all the power and the semiconductor capability to create that capability. So countries such as Japan has the test equipment. So when people are building manufacturing capabilities, they need the semiconductor equipment tests. They need the materials around that. So it's not just the US. And I think we will see that the next wave of AI, which is more on like the true implementation of the business, when it translates into actual real number that will benefit the company moving forward, it can come from other parts of the world. It doesn't always have to come to the US. But yes, the US, of course, has been leading the path. But the path forward may be a lot more broader than what we have seen.
Will that offer growth, though? Because I always feel like in the past, the diversification outside the U.S. has been much more of a value play than a growth play. Do you see that shifting, that more growth, not just in AI itself, but just overall, we will start to see potentially more growth out of non-U.S. markets?
Yeah, so I think we can see growth, especially on like the semiconductor ecosystem and the supply chain. The value play, I think you're referring to Europe, where all the companies there are more of a value play. But even like within Europe, if you look at UK, for example, they've been focusing more on their like the financial part of it. And then Germany, there's like defense spending as well. So there's now pockets of opportunity outside. So actually it's the best time for investor to be able to look globally, because now you can have a lot more choices than just your US large cap.
All right, Dina, great stuff. Dina Ting is head of Global Index Portfolio Management at Franklin Templeton, counting us down to the closing bells. Just about 2.5 minutes to go. Katie Greifeld, stocks holding basically the same pattern they were in when we started the show. The Dow leading the charge. Yeah,
quiet day if you train your eyes off of the Dow. Could be an interesting after-hours session. Looking forward to Cisco results. Those stocks, that stock in particular, closing in on its .com high.
Yeah, expected to get those results from Cisco momentarily as we move closer to the closing bells. A full breakdown of everything that happened today and a push ahead to what comes next. That starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. Carol Massar,
yes.
This is the second day in a row we've seen massive outperformance by the Dow Jones Industrial Average.
What does that
This will be the
mean?
most we ever talk about the Dow Jones Industrial Average.
What does that mean?
In
You
days.
and
I don't know.
Well, yesterday it meant that NVIDIA wasn't in it. That's what it meant.
It's either a harbinger of things to come or a harbinger of gloom and doom.
But do you know, I hate to say this, Romaine, but you and I are old enough to remember that that's when people would mostly talk about the Dow Jones Industrial Average and not necessarily the other indices. So I don't know what it means when we're talking about it this much.
I think it's cute. Carol thinks I'm as old as she is.
I think it's cute that you think I'm as old as you are. Touché.
How old are you, Tim?
Katie, your turn.
I don't think it means much that the Dow is outperforming. I do think it means that Goldman is having a great day. So too is Cisco. That's a weight in the Dow, and that's a company that reports in the next coming minutes. So there you have it.
Yeah, and I think the Cisco earnings are going to be good. Of course, you know, this is kind of the classic bridge between kind of the old school tech, if you will, kind of the back in the dot-com bubble, the telecom build out, and now the AI infrastructure build out, and the idea that Cisco, at least for right now, appears to have found a bit of a niche for itself in that AI space. It'll be interesting to see what those results look like in just a few minutes' time.
You know, a lot of people are comparing this era to the first dot-com bubble era, and there are some similarities too with where we're seeing Cisco and Cisco's performance, Romaine, just in recent months.
All right. Well, I know you hate to hear it, Katie Greifeld, but the Dow Jones Industrial Average not only higher on the day, it's at a record high and has actually outperformed the S&P in 6 of the past 8 sessions. We're seeing a 0.7% gain here on the day, up more than 300 points. The S&P is poking out a gain, but only about 4 points or less than 0.1%. The NASDAQ Composite and NASDAQ 100 each going to finish in the red on the day, as is the Russell 2000, which drops about 0.3%.
All right. I'm going to go there. We've got 20 names in the Dow Jones Industrial Average.
You did not.
Higher in today's session. All right. In the S&P, 296 names gaining ground, 205 to the downside.
Now, if Katie's circle is the Dow, I'm going to scream.
Can you imagine if the producers did that to me? No, I don't think Finley would. Let's take a look at the circle, which shows the sectors in the S&P 500, the Standards & Poor's 500. You can see that big tech there represented. That is one of your best gainers on the day. Healthcare also having a big day. So too did financials. I mentioned Goldman being higher today. In terms of what didn't perform, energy is one of your biggest losers on the day. So too is communication services. That includes Amazon. Almost an even split. Of course, there's only 11 sectors, 6 of them, though, in the green and 5 in the red, Carol.
All right, folks, as we wait earnings, AMD, your top gainer in the S&P 500 and the NASDAQ 100, a gain of 9% in today's session. The company projected accelerating sales growth over the next 5 years, driven by strong demand for its data center products. Remember, they had a meeting yesterday, and the CEO making some comments. She said the total AI chip market will reach $1 trillion by 2030. So again, that stock definitely an outperformer. All of the airlines, check it out, folks. Among your top gainers in the S&P 500, you have United up 5%. You have Delta up 4.7%. SkyWest up about 4%. Wow. What's the matter with Delta?
I got a little beef with Delta.
Yeah, I know you did.
What happened? What happened?
He got stranded.
Nothing happened.
He got stranded. All right, anyway, expectations, hopes for the government opening. That has given some life to all of the air traffic controllers. Maybe some of that will ease. Transportation Secretary Sean Duffy said today that the administration aims to start lifting flight curbs within a week after the government reopens. So a time frame that comes just ahead of that very busy and important Thanksgiving holiday season.
Were you at an airport recently or something, Romaine?
Sadly.
Okay.
I think I spent more time at the airport this weekend than with my family.
Oh, okay. Real quickly, Cisco going to report earnings any moment. That stock, as Katie mentioned earlier, an outperformer in today's session, or Romaine and mentioned. So we're looking for that AI payoff because the stock is getting very close near its all-time high. Stock up 3% today.
All right, Carol, with the gainers, I got the decliners. I want to start with Circle Internet Group, down 12.2% today. The stablecoin issuer fell as concern that declining interest rates will weigh on future returns, overshadowed better than expected record third quarter revenue and earnings. We did speak to Jeremy Allaire a little earlier on Bloomberg Markets, and he made the point that growth in the stablecoin industry, that more people adopting these will offset some of the declining rates that they're declining revenue that they're getting from rates coming down. Still, though, analysts and investors questioning what happens moving forward in a declining rate environment. Revenue did increase to $740 million. That came in above the average analyst estimate. Also, shares of Paramount Skydance fell today by 7%. They were up close to 10% yesterday after earnings. Took a bit of a hit today. No fundamental news, but we did see shares move even lower than they were earlier in the session after Democratic Representatives Jamie Raskin and Frank Pallone Jr. wrote to Paramount Skydance CEO David Ellison asking that the company comply with an investigation into the Paramount Skydance merger. And finally, BlackRock Coffee with its first post-IPO earnings report.
Oh, cool. I didn't know Larry Fink was branching out.
That's funny.
Thank you.
It's 2 words, not 1 word, okay?
Okay.
BlackRock,
right.
2 words.
They have not been sued yet?
I haven't seen the news there. Okay. Down 5% today. BlackRock Coffee Bar. This after the company reported its first quarter earnings report, its first one since the IPO back in September. It opened 11 new stores in the third quarter of the year. Total revenue up 24% compared to the prior period. Shares up around 15% since that IPO, but off 17% from those all-time highs.
All right, we should remind our viewers that we are awaiting potentially for a vote in the House of Representatives down in Washington that could potentially bring an end to this 40-plus day government shutdown, the longest ever. And of course, with the end of that shutdown, in theory, would come the resumption of economic data, and that played a big factor in the moves that you saw in the Treasury market today, a rally in Treasury prices that push yields lower in anticipation that that data, once we start to see it, will actually ratify the need for more rate cuts.
All right, so good to know. Hey, listen, as we await some earnings crossing, including Cisco, just in case you guys were worried about Kim Kardashian and her financial future.
Yeah.
Looks like she just got a valuation of about $5 billion, a new funding round, Katie.
Wonderful. Cisco earnings crossing the wire right now. Sorry to interrupt your Kim Kardashian conversation.
Go on.
Actually, they're not crossing the wire. I was joking.
Stop. We did the wipe and everything.
I know, practice.
Wait.
You could do Webtoon, Romaine. Why don't you do Webtoon?
All right. Well, anyway, I don't know. I mean, Webtoon, of course, is having a deal here with Warner Brothers, going to create some content for them. The share is moving higher here in the after-hours trade. That is the main headline. Actually, they're moving lower. Excuse me. It had gotten a little bit of a pop on that news, but you see the numbers there on your screen here, a miss on a couple of key metrics, and that does appear now to be pushing the shares lower, down by about 20%. I do think we should turn back to Cisco. We are starting to get that trickling across the wire right now. It may take a while for us to break through these numbers, but they are providing a forecast for the full year adjusted EPS range 408 to 414. That's a slight nudge higher from the previous guidance that they had given, guys, where they were looking at adjusted EPS of $4 to 406. So just basically a slight modification higher here. The company also saying that revenue for the full year will be $60.2 billion to $61 billion. The low end of that range is just a smidge above the high end of the previous range that it had given.
Yeah, so we're getting the guide here, and you can see it's boosting shares by about 4%. Still waiting for some details here. And here's a little bit more. Second quarter adjusted EPS coming in between $1.01 to $1.03. The estimate, for context, had been for 99 cents, so a bit of a beat there. They also see second quarter revenue between $15 billion to $15.2 billion. That is also above the estimated $14.72 billion. So a lot of raising going on here, and you can see that in the shares. Again, higher by 4%, Carol, and this is a company where the bar was fairly high going into these numbers.
Yeah, gross margins, the second quarter adjusted gross margin, 67.5% to 68.5%. The estimate, 68.2%. And Chuck Robbins, chair and CEO of Cisco, I'm just looking at the PR Newswire release. We had a solid start to fiscal 2026, and Cisco is on track to deliver our strongest year yet. He said the widespread demand for our technologies highlights the critical role of secure networking and the value of our portfolio as customers move quickly to unlock the potential of AI. And this is really important to this company's future.
Okay, you're looking at Cisco. I'm looking at what's happening with Flutter Entertainment, that is. Third quarter adjusted earnings per share coming in at $1.64. The company sees fiscal year U.S. revenue at $7.17 billion. It saw $7.58 billion. The The estimate was for $7.47 billion. That third quarter revenue missing estimates. Shares right now in the after hours down about 6.2%. Third quarter average monthly players, $14.13 million. Flutter third quarter revenue coming in at $3.79 billion. That below estimates. FanDuel and CME Group unveil a new prediction markets platform as well.
And as Katie said, the expectations for Cisco were pretty high. That stock rallying in the aftermarket up 4%, and it's already up about 25% year to date ahead of these results. So we'll look for more on Cisco and certainly on that call with investors and analysts. All right, guys, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Tim and I continuing right here on radio. Katie and Romain continuing on the close on Bloomberg TV. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television with the biggest upside mover in the after-hours trade, Cisco. The company out with its earnings and a slight bump up in its forecast. We break down those results when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. And Katie, if you are a Dow hater, today is not your day. Similar to yesterday, the Dow Jones Industrial Average was the outperformer amongst the major U.S. averages and indices. In fact, the Dow at a second straight day, a second straight record high, up about 0.7%. And that's not necessarily a ratification of price-weighted indexes, but more this idea here that there is a bit of a rotation out of some of those higher value tech names and into some of the laggards in the space, including some of the healthcare names, some of those that you can find in the Dow. The NASDAQ unchanged on the day, but keep an eye on the commodities space as well. There was a lot of activity based on some comments that the Treasury Secretary Scott Bessent made about the potential of easing of some tariffs, particularly on goods like bananas and coffee. Coffee futures, Arabica coffee futures dropping about 6% here on the day. And the coin called BIT, Katie Greifeld, still trying to get out of its fit of morass.
Yeah, and you can see it's still above 100,000 per coin. We know it dipped below there a week or two ago. We'll see if it can hold. But let's take a look at Cisco, of course, reporting earnings in the past few minutes. Shares up about 4% after hours right now. This is a company that boosted its guidance for the full year ahead and also for the second quarter, translating into shares after hours. And Romain, as we've been talking about, of course, expectations were high for Cisco. Shares up nearly 25% year to date into today's close, nearing in on its dot-com peak. And if this momentum continues into the regular cash session tomorrow, we very well could get there.
Yeah, we've been hearing a lot about how Cisco has really been going out there trying to update its networking gear, update its chips to better connect all of these server racks and data centers that are being built at a massive clip. Lindsey Bell joins us right now, Chief Investment Strategist at 248 Ventures, who has invested heavily in the tech space, not necessarily Cisco. But I do want to get to this idea of this build out. And when you look at what Cisco has done, this idea of just kind of taking legacy products, updating them for a new age. Is there room out there in this AI build out for, and forgive me, Cisco, if you're watching, for kind of these legacy old school tech names?
I mean, I think their earnings report today showed us that there is. And that's the thing about this stock. Yes, it's up 25% on a year-to-date basis, which is pretty good. I say it's middle of the road because it's in line with the NASDAQ and some of these other big AI growth names are up much more significantly. But I think what we're seeing here is that they're in the very early innings of this. If you think about just 5 quarters ago, Cisco didn't have any AI-related revenue on the back-end revenue servers. So this is really good stuff. They raised their guidance. Their margins are expanding too. I think this is a stock with a lot of healthy skepticism about their ability to benefit from that AI trade.
Absolutely. And it gets to this idea when we talk, I mean, we've gone through some of the numbers here, but I mean, kind of eye-popping. You talk about revenue projections of roughly about $15 billion for the current quarter that we end, that ends in January. But also, I am kind of intrigued by this idea that we've seen other names from kind of the old kind of dot-com internet boom sort of resurge. Oracle obviously being kind of the poster child for that. And so when you're looking for investments in the AI space, I know it's tempting to just go after NVIDIA or maybe now AMD, but do you think when you're talking to clients and people are asking, where do you allocate to take advantage of that AI trade, Lindsey? I mean, what do you tell them? You can't just be saying just buy NVIDIA, right?
No, I do think there's opportunity in some of these other names, especially the stocks that have lagged. I mean, Apple and Amazon aren't necessarily big AI names. Amazon has a greater exposure to the AI trade, but people are looking for value, more value in the tech space now. And I think after we heard earnings from those two names, and some of these other names that are the legacy trade that are reshaping themselves, evolving into companies that can benefit more from the AI trade, but also have this dispersion within their business. It's not just AI. That's a benefit, and I think that gives them cushion. Their stocks haven't performed as well as some of the other ones this year, but they're still doing good, and their valuations look better. I look at Cisco and I say, hey, this stock is trading just under 18 times on a forward PE basis. Yes, that's extended from its historical average, but again, we're getting into new businesses with hopefully higher margins, and it's still trading at a multiple that is below the tech sector. It's below other AI names, and heck, it's below the multiple on the S&P 500.
Well, that's where I wanted to go, Lindsey. You mentioned the valuation of Cisco. We saw an upgrade from UBS on Cisco earlier this month, and the reason for, or rather KeyBank, UBS also upgraded, but KeyBank in particular called Cisco, quote, a relatively inexpensive way to invest in the AI thematic. So when you think about the AI trade holistically, the different names that populate that, how many underappreciated, potentially inexpensive ways are there left to play this, given that we've been talking about it for 2-3 years at this point?
Well, I think there's still many innings left in the AI trade. We're starting to hear the narrative about this spend. How long can this go on? What's the ROI going to be when we take into consideration the debt that has been being taken on to fuel this spending? Well, you look at AI investments as a percent of GDP, and it's about 1%. In other technological advancement cycles, the spending is usually between 2 to 5%. You look at ROE now versus back in the 2000s. If you look at CapEx as a percent of sales versus back in the 2000s, when you're thinking about this bubble talk, you're seeing that these numbers are nowhere near there. And then, I mean, if you put, you look at the numbers of what is expected, cloud revenue growth and 26% for the Mag 7, that seems to support more CapEx spending in the space. You listen to these companies, AMD talking about the insatiable demand for AI chips. NVIDIA says they can't keep up, they can't ship to meet the demand for their chips. And so I think there's real data, real information out there that shows that there's a longer runway in this AI trade than where we're at right now.
I do want to bring in, though, the spend into this conversation. We don't have a lot of time left, but you think about some of these tech giants coming out and having to tap the bond market in a way that they haven't before. They still have free cash flow to spend, of course, and that's how they funded the bulk of the ambition thus far. But again, these mega cap tech companies really coming into the primary markets and issuing debt, does that change how you view them as equity investments, or could it in the future?
I think it could in the future. It's something that we certainly need to keep our eye on. I think JP Morgan came out recently and said they expect the hyperscalers to issue 1.5 trillion in investment grade bonds over the next 5 years. And there's going to be more sources of the capital markets that are going to have to help fund this spend over the next 5 years. So it's something that we certainly need to keep an eye on. And I think that we have hindsight of 2000 to hopefully keep us vigilant. But it's something that we'll keep an eye on.
All right, Lindsey, great to get some time with you. That is Lindsey Bell, Chief Investment Strategist over at 248 Ventures. Now, coming up, change is inevitable and for some, irresistible. As return to office mandates take root, IBM's former General Manager of Design, Phil Gilbert, joins us to talk his new book on transformational innovation. That conversation up next. This is The Close.
Younger people being left behind, their social lives are deteriorating, they don't get ahead. But even all of us in management, when we meet on Hollywood squares, there's not as honest a conversation. You don't have that constant follow-up. People say, we'll pick it up next week when we get there.
Jamie Dimon doubling down on his case for return to office. And come on, Katie, it is a beautiful office.
I know.
But this is paramount. Braces to get back to 5 days a week in office with roughly 600 employees taking severance to avoid the full-fledged comeback. Now, our next guest led a multi-year design overhaul at the tech giant IBM from 2012 until his retirement from the company in 2021. He's out with a new book today. It's called Irresistible Change, a blueprint for earning buy-in and breakout successes. He details how we got 400,000 employees on board with the idea. The change is not only inevitable, but already here. Phil Gilbert is here, live in studio. Great to have you, sir.
Thank you, Romaine.
All right, let's start off first with this idea. I know everyone's talking about return to office. We've been talking about it forever. Yep. Some of us have never left the office, by the way. But it gets to this idea also of making a work environment that people want to come back to. And I felt like during the kind of the internet boom, it was all about having, foosball tables and, some snacks and things like that. But it gets a lot deeper than that because it's not only getting people to come in, but staying there and also being productive.
Absolutely. And I'm the biggest fan of everybody being back in the office, but it's typically not for the reasons that most management talks about. The team-based collaboration is actually quite effective anywhere. Yes, you need some in-person time. You also need remote tools are fine too. But what physical places give us are the ability to support the things around work that actually make work better. And that's what I think a lot of executives are missing, is they're putting the burden on the employee via mandates instead of shouldering the burden of creating spaces and places that actually add value to people's lives and that actually accelerate the outcomes that they're trying to see in the marketplace.
I am curious, when you joined IBM, you kind of came through an acquisition.
Yes.
They bought your company, and they kind of left you off to your own to kind of do what you want with Lombardi software, right? Was that what it was? Yeah. On your own, and then I guess at some point someone decided that whatever the heck he was doing over there should be applied to the broader company. But IBM was a behemoth, still is a behemoth. So what was that process like of running essentially a smaller company within a company to now trying to apply that design aesthetic, if you will, to the entire company?
It's a great question, and it's really the premise of the whole book, and that was the magic trick that we had to pull off. In the small part of IBM that I was running after the acquisition, I was running it, and so people kind of did what the leader said to do. When the CEO at the time, Ginny Rometty, asked me, whatever you did there, let's do it everywhere, I had to figure out a way to get 400,000 people to do something, none of whom reported to me. And that's when I really came up with this notion that that's actually the exact same problem that a startup has with a new product. And so we should package change as a product. It shouldn't be mandated, but the burden should be on my leadership team to make something so valuable to every team in the organization that they would choose to come in. And that's what we did.
So where do you think a lot of those startups go wrong? Or you think about, now we're actually starting to see M&A come back, and when you combine cultures, it is difficult. So where's the easiest place to potentially trip up, so to speak?
Well, you certainly need the support of the executives in the organization. And the organization has to have a certain willingness to change. But I think, again, where most startup people get frustrated is they look around and they see the systems and the people that are in place, and they fight that instead of trying to show and lead the organization into new areas that the organization willingly comes to. And that's what we were able to do at IBM. We started with just a very few teams in the first year, but by the second year, we already had more demand of teams that wanted to come in to our program than we could actually even support.
And Phil, I'd love to bring in AI to this conversation because it feels like it's a central part of every conversation. So what we're talking about, both when it comes to actual physical spaces in offices and then sort of combining culture, I wonder what role AI plays there, if any.
Well, it's certainly another tool. But I think one of the problems with the transformation efforts that are going on around AI and why we're seeing so many of them fail, just like every other transformation, so many of them fail, is that people are too focused on the technology and not enough on the systems and people and processes around the technology that also have to change. We tend to get blinkered when we say we're doing an AI-first implementation. We tend to get blinkered around the AI as the only thing that we're inserting, the only thing that we're changing. When in fact, all of the HR systems need to change. The career ladders for all people need to change. The tooling around the teams.
But do you think CEOs and other executives are doing a good job in articulating that? Because, I mean, that makes sense, but I feel like that's not what we hear from them, at least not publicly.
No. No. People are still getting too focused on the tech, on the tool, just like we did with Agile, just like we've done with every single transformative method or technology in the past. We get too focused on that thing and not focused enough on the systems around the thing. And in our work at IBM, I will tell you that at least 50% of the work of my team was nothing to do with design or design thinking. It was with everything else that would then reinforce it going forward. And that's what made it stick.
Well, Phil, that's a nice place to leave it. Great to get some time with you. That is IBM's former general manager of design, Phil Gilbert, author of the new book, Irresistible Change. Now, coming up next, Chevron capitalizing on the AI boom with a new data center project. We'll discuss with CEO Mike Wirth, fresh off their latest investor day. That conversation up next. This is The Close. Chevron heading to West Texas, where the oil giant will build its first AI data center power project. The facility expected to be operational in 2027 as the energy company looks to capitalize on the boom in AI. Here to discuss is the man in charge. His name is Mike Wirth, the CEO of Chevron. Mike, great to see you in person.
Katie, it's good to be here.
So let's talk about, of course, this AI data center power project, because I have to imagine this decision wasn't taken lightly to enter the energy or the power business, that is. So walk us through the decision tree there.
Sure. Well, first of all, we had an investor day today, our first one in almost 3 years. We had
Congratulations.
Thank you. We had a chance to talk about Chevron being bigger, stronger, and better than ever, with growing free cash flow and earnings over the next 5 years, free cash flow growing at greater than a 10% compound annual growth rate, driven out of our core business and then supplemented by opportunities like the one that you refer to. We started working on this at least a couple of years ago, as we could see the coming boom in AI and the need for more power to support the data center build out, and anticipated that grid-connected power could become increasingly problematic as people saw their electricity rates go up. And so our project is disconnected from the grid. It will serve only a dedicated customer for AI. And of course, the customers in this sector want large scale. They want it soon. And so we've made commitments to several large turbines, a lot of engineering work underway, site acquisition and permitting work underway, and we shared that with investors today.
And so this, of course, will be operational by 2027. That's the plan. Who knows what the world will look like? And you think about Chevron, obviously synonymous with oil and gas. But should we see this AI boom really continue and maintain sort of the trajectory that it's on, how big do you think that the power business within Chevron could be?
Yeah, it's hard to say. This is a first step. It's not been a core part of our strategy historically. And we have great respect for people that generate power, that serve utilities and customers today. That's not the market that we're going into. We're really talking about something that we do to support our own business. We have 5 gigawatts of power generation. We run 24 hours a day, 365 days a year to support facilities in remote locations that don't have access to the grid. This is a very similar concept where we will set up a facility that will have natural gas supply for the turbines and data center customers clustered around it, that it can serve at a high degree of reliability, just as we do for our operations around the world. And so if it works for us, we would like to extend that and see if it can become a larger part of our business. This first step, I think, is one that we'll learn a lot from.
And just to be clear, I mean, most of this gas you more or less have, right? I mean, it's there on your own properties, right?
This is in West Texas, the heart of the Permian Basin, where not only is there a lot of oil production, there's a lot of gas that comes with that.
Right.
Often this gas can be discounted because it's far away from the market center. We need to get it into pipelines and move it. So to create a demand hub close to where all this gas is, and will be for many decades, is a way to use that and not need access to all that transportation.
Is the connectivity there, though, the idea of being able to transport that where it needs to go, is that there, or will it be there soon?
Well, one of the interesting things is it's actually easier to build fiber networks than it is pipelines. And so you can locate the data centers close to the gas and the power. You can connect into the fiber infrastructure. And moving electrons is easier than moving molecules. And so that is kind of at the heart of this location and the reason that we're looking at West Texas.
And let's talk about where else you're looking outside of West Texas, because I know that you've said that you're going to increase exploration spending by about 50%. I know that you went into a little bit of detail in the Investor Day about where in the world you're looking, but where do you think that the most promising locations are at this point?
Well, we've acquired a lot of new acreage around the world in South America, where there's been a lot of success in Guyana, in Brazil. We've acquired acreage in West Africa, where there's been success in Namibia. We're the largest leaseholder in the Gulf of America today, where there's a long history of success, and we're one of the largest producers. And we're also interested in the Mediterranean, where there are some areas that remain underexplored. So we're exposed to a number of interesting basins around the world, and I think over the next several years you'll see increased exploration activity in all of those.
Mm-hmm. And when it comes to new countries, entry into new countries, you think about Iraq, you think about Libya, does the Trump administration play any role in helping to guide along those negotiations?
I wouldn't say there's a role in guiding the negotiations, but there's certainly been a role in opening the door. I think we see countries around the world have a renewed interest in doing business with the U.S. That's both bringing investment dollars to the U.S. and also opening up their countries to investors from the U.S. And I have any number of examples where we have operations around the world, and we've seen new opportunities that have developed for our industry and others to invest in both directions. And so I think the Trump administration has played a critical role in opening doors and creating an environment where people are looking to do these kinds of deals.
Based on what you can see, how far out you can see, are economic conditions going to be supportive, not only to what you were just talking about there, but also some of the projections that you gave investors today with regards to free cash flow, et cetera?
Absolutely. Demand for energy will only grow into the future. In fact, the International Energy Agency today updated their scenarios, including laying out a scenario based on current policies that shows demand for oil and gas growing to 2050. Very different than what some of their prior scenarios have indicated. We've long held a view that that is more likely than some of these other scenarios. So the underlying demand is very strong. Our portfolio is resilient. Even at a lower oil price, we can generate strong free cash flow. We've increased our dividend 38 years in a row. We've repurchased shares 18 of the last 22 years. So we've got a very strong track record of distributing free cash to shareholders. And at any price, we're well positioned to do that.
Well, not at any price. I mean, we're
at any reasonable price.
I mean, we're at $60 more or less for Brent and WTI. Is the idea that if that for some reason came down into the 50s or even below, is that still doable?
Oh yeah, absolutely.
Yeah. Okay.
Our dividend, we increased our dividend during COVID when prices were, in the teens and went negative for a while. And so we've got to prepare for the volatility of a commodity business. That's the business that we're in. And we've built a portfolio that will withstand the cycles of this business.
Well, with that in mind, I mean, you talk about demand, it looks pretty good there, but then you think about the supply side of the equation. I know that you said earlier today that LNG spot prices in particular are going to be pressured due to high supply. How does that sort of dynamic overall look going into 2026? Does it ever come more into balance?
Well, I think oil prices in 2026 are likely to feel more pressure than LNG prices. There's a lot of oil supply that's coming back from the OPEC plus countries that had been holding supply back. And so that has brought crude prices lower than they had been for the prior period of time. LNG is a little bit of a longer dated story where there are a lot of new projects underway in the Middle East and in the United States that will add supply in large chunks over the second half of this decade. And demand tends to grow in a linear fashion, and you get a step change of new supply. And so there's a period of time when it would appear we're going to see more supply coming into the market than demand will be able to absorb. That probably results in lower spot prices. That's the commodity business that we're in.
Are there any sort of technological improvements that you see that actually makes the supply side of it a little bit more efficient?
Well, one of the things we talk a lot about today was not the power demand of AI, but what we can do with AI to improve our business, to make our business safer, to reduce emissions, to improve asset productivity, to improve efficiency, to improve our ability to explore for and find resources. And I think the story of technology in our industry is it only goes in one direction. It helps us do things at lower cost, at higher efficiency, and I think that story will be rewritten again with AI leading the next leg of that journey.
With regards to leading Chevron, and you've done a great job, and investors seem to be rewarding you. Your plans right now to stick around?
I'm happy. I've got a full plate, and my plans are to stick around as long as the board will have me, yes.
All right. All right. Well, I really appreciate you joining us today, Mike.
Good to be here.
Mike Wirth there, the CEO of Chevron, fresh off his Investor Day here in Studio 2 in New York.
Meanwhile, let's take a look at how markets closed on the day and how they're faring in the after-hours trade here. We have two names up on the board. One of them is Cisco, higher by about 6.5%. They boosted guidance for the full year and for what they see for the second quarter, so delivering on those high expectations with the stock. Flutter, not much of a reaction, 0.7%. Going to be interesting to listen to the call there and see what commentary they have on the underlying business, but also on prediction markets as well. This is the close on Bloomberg. "43 days and counting, the U.S. government inching closer to reopening as House lawmakers get ready to vote shortly to end the longest ever shutdown in Washington. Bloomberg Balance of Power co-host Joe Matthew joins us now live from Capitol Hill. And Joe, give us the latest here, because this isn't exactly a done deal yet.
Well, that's right. And, you know, we love superlatives around here, and we've been setting records on the daily for a while. So looks like it's about time to bring this to a close here, Katie. And it's expected to happen likely in the 7 to 8 o'clock hour once we get through some procedural voting on the House floor, remembering that this plan passed the Senate a couple of days ago. Lawmakers have taken their time to get back into town. There's one lawmaker, even from Wisconsin, who had to ride a motorcycle a couple of 100 miles to get here in time because it's been so difficult to get on an airplane. But by the time we all leave this evening, it is expected the House will have passed this bill that funds the government through the end of January. And it also gives year-long funding for departments like Agriculture and Veterans Affairs. The president then expected to sign that and will be open for business tomorrow. The big question is, how long will it take for SNAP benefits to be restored? It could be weeks, not days. And how long will it take for the airline and air traffic control system to get back on track? The answer might be the same there.
Yeah, and Joe, we're going to talk about that in a second, but I am curious just about the politics behind this. There was obviously some concern among some Democrats about the deal that was struck in the Senate. I guess that backlash wasn't furious enough to derail what's about to happen in the House. What are you hearing from House leadership right now about their comfortability with this potential deal?
Well, I think the Speaker of the House is on board, and this is something that was hashed out with John Thune and had the blessing of the president. Democratic leadership is a very different story, and they're not terribly happy about the fact that 8 Democrats, I guess 7 Democrats and an independent in the end, crossed the aisle to pass that bill in the Senate, which brought it back here to the House. You're going to see a lot of Democrats vote no on this, and coming up at the top of the hour, we'll talk to one. Susan Del Bene runs the DCCC. She's responsible for getting Democrats elected to the House in the midterms. And this story today, what you're seeing unfold right now, is going to go a long way to impacting outcomes in those elections.
Bloomberg Balance of Power co-host Joe Matthew live on Capitol Hill, where I think he's going to be spending quite a bit of time as he awaits that vote out of the House. Be sure to check out Joe and his team at the top of the hour for all your political coverage. Meanwhile, we continue our analysis of the potential end of the government shutdown and what it really takes to get the government back up and running. Wendy Edelberg joins us right now, Senior Fellow of Economic Studies at the Brookings Institution. And we should point out, even if this gets passed tonight, still got to be signed by the president. And then it's going to take a while for the agencies to get back up and running. You have payrolls that need to be updated. You have SNAP benefits that need to be reinstituted, an air traffic control system that appears to be on its last leg. Wendy, is there any way to, now to even quantify not just what the potential economic impact has been, but what it might continue to be over the next few days and weeks?
You're absolutely right that we're not going to be able to switch everything on immediately. That said, what I'm actually more worried about, much more than in previous shutdowns, is the persistent long-term effects on productivity of the federal government. Any federal worker who had not yet been job hunting probably got the message in the last weeks. The federal government has not acquitted itself as a trustworthy employee. And I worry that we will lose the best of the federal workers, and people who come back are going to be coming back quite frustrated and, maybe not so sure that they are actually welcome back at their desks.
Yeah, and we should point out, obviously, this all goes back to January. Of course, DOGE coming out, and that rattled a lot of federal employees. A lot of the conversations that have come out of the White House with its approach to these agencies has been one more about contraction and attrition than growing it. And now you have the shutdown, Wendy. So I am curious as to who actually comes back. I know most people will come back because they need the paycheck, but as you said, I assume a lot of these people are going to be looking for better opportunities if they're out there.
Oh, absolutely. I mean, but at this point, most federal workers outside of the military have missed 2 paychecks. And, one paycheck is a little bit like normal course of business as a federal worker. Shutdowns happen. 2 paychecks, and with the threat of missing a 3rd paycheck on the horizon, that starts to become financial catastrophe. Yeah, absolutely. I expect everybody to come back. Keep in mind that we will never get back all of the economic benefits of the work that these furloughed workers should have been doing. That's just a loss. And so, we'll see gyrations in the economic numbers. We'll see a loss of GDP in the 4th quarter. Agencies won't have been spending all of the money that they normally would have spent on stuff. Federal workers who miss paychecks won't be, doing as much spending until those paychecks are reinstated. The SNAP recipients no doubt pulled back on their overall spending. So we'll see a reduction in spending in the 4th quarter. Largely, that will get reversed, in November and then in future months and into next year. But again, we will never get back the work that should have been done by these furloughed workers.
Right. Well, also to add to the conversation on folks coming back, I wonder about people coming into the government, to speak about the country as a company. I wonder, how much this experience will hurt recruiting, if you want to call it that, or whether this is something that will only last through this one administration.
I mean, it has to hurt. I certainly know it doesn't help. And, each time you each time the federal government shows itself to be an unreliable employer, it hurts recruiting. And yes, it absolutely is recruiting. The federal government, much of what the federal government does is a force multiplier in our economy. We need the IRS helping businesses stand themselves up as non-for-profits. We need FHA helping people get mortgages. We need, the Small Business Administration helping small businesses get loans. All these things are actually, in many ways, the lifeblood of the economy. And if we have a workforce in there that basically has one foot out the door, it's just going to tie one hand behind the federal government's back.
And Wendy, you make the point that, the work that was lost during the shutdown from these furloughed workers, it's never coming back. And I want to bring this conversation into the data, because some of the data releases that we were supposed to get during the last 40-something days are probably never going to be seen. We heard from the White House today that the October jobs report, the October CPI report, unlikely to be released. And I know that by training, you're a economist and economist. God, it's really hard to say words today. But I just wonder, how you view the state of the economy right now and what this means for the monetary policymakers in charge of making policy here.
Well, I don't want to overstate things. Missing 1 month of even these very important aggregate economic statistics, as important as they are, monetary policymakers will have the information they need to make decisions. That said, yes, it's just a self-inflicted wound. Why on earth would you want to hamper one of the most productive things that the federal government does, which is accurately assessing what's happening in the economy? No, it's super frustrating. That said, I'm not 100% sure that the White House is right. I mean, they surely have more inside information than I do. But it is likely that, for example, the Bureau of Labor Statistics will be able to ask firms, tell us about your hiring in October. There will be some ability to do a look back.
How much do you think markets are going to trust this, Wendy? And I ask you that not only through the lens of your current job, but obviously you spent a lot of time in the government, the CBO, at the Fed, a couple other places I'm probably forgetting. And I mean, through my entire career, I never really doubted the data and other information I got out of the government, not in any material way. And when you look at the lapse in data collection and dissemination, and the disparaging comments that a lot of people in this administration have made about the folks and agencies creating that data, why am I to trust that going forward, that what I'm going to get out of these agencies is going to be an accurate representation of the economy?
Well, it's so depressing that you're worried, and a lack of credibility in our institutions would just be a travesty for our economy, for certainty, for making plans. And I would throw into that bucket lack of credibility of the Federal Reserve, which is perhaps the most important institution for our financial sector. That said, I want to be clear, I have nothing but faith in the staff at these agencies like the BLS and Census. I know they are doing, excellent, honest, credible work. But in some ways, that makes it all the more worrying if the public loses faith in them, because it's not like we can then point in the future to some switch that we flipped and said, see, now you should have faith. It's just a sort of a general pervasiveness of a lack of faith that, that how can you earn it back?
All right, Wendy, I appreciate you taking time for us. A very sobering discussion. Have to get you back on for maybe a happier conversation in the future. Wendy Edelberg, Senior Fellow of Economic Studies at the Brookings Institution, as we now have all eyes on the House of Representatives, potentially going to pass a budget compromise at some point tonight that would allow the government to reopen. We're going to set you up for what else to watch over the next 24 hours when we come back after the break. This is Bloomberg. Here's what the markets are going to have their eyes on over the next 24 hours, and it includes some pretty big earnings. Katie Greifeld.
Disney, JD.com, that comes pre-market, aftermarket, SubHub, and Applied Materials to look forward to.
Yeah, really curious to see what Disney has to say in the morning. And of course, Applied Materials after the bell. A lot of Fed speak, including from some of your favorites, Katie Greifeld, Mary Daly, Neil Kashkari, Muslim, Beth Hammock.
Yeah,
who you got?
Big time. I'm excited to hear from all of them. And then also some annual general meetings underway from Tapestry and Estee Lauder. So a lot to chew on there, Romaine.
Yeah, it'll be interesting to see what kind of forecast they feel comfortable given in this current environment. Meanwhile, stick around for Balance of Power update in real time of what's going on in the House of Representatives and the government shutdown.